traders, and welcome to a new day trading strategy video of mine. In today's video, we're going to be going over mastering volatility. In the past, I've talked about the average true range, which is an indicator that looks at volatility. And I've also looked at when to trade low volatility, when to trade high volatility, different kinds of coins. But what we're going to be looking at today is looking at one coin's cycle from low volatility to high volatility and back again. Also, I'd like to give credit to M59 on my Discord, as he is the one who created the indicator that we are going to be looking at today. So this cycle of volatility, where we get low volatility, then high, then low, and on again. The reason we get that is high volatility occurs when there's high interest to transact at current prices, and we're going to have a large amount of interest to transact at the current prices when demand is greater than supply, or when supply is greater than demand. So volatility occurs in this stage typically. We typically are going to get low volatility when there is low amount of interest to transact at current prices. So really, both buyers and sellers believe that they're trading at fair value. Here and here, we get accumulation and distribution. Additionally, high volatility will also usually have high volume, and low volatility will typically have low volume. The reason that occurs is high volatility, for price to move with that much fluctuation, you're probably going to see a large amount of transactions. Whereas with a low volatility, we're probably going to see not as many transactions because there's just not as many interested traders looking to buy or to sell. And finally, the point that we're going to be talking about today is transacting in a low volatility range leads to higher potential profit, whereas transacting in high volatility typically is going to be a lower potential profit. Now, what I mean by that is when you look at an uptrend, typically the best spot to buy is at the base of the uptrend. Typically, the base of the uptrend is going to have a low volatility, where we're going to see a period of just really not much happening. And then we get a pop upward, and then we get the uptrend continuing to move higher and higher. You can buy in retracement, you can buy momentum of the up sometimes, but really the best spot is to buy down here. And that's why we want to try to aim to trade only low volatility and avoid high volatility unless one condition is met, which we will talk about today. I think a good way to think about getting your order filled and volatility is negotiation. Whenever you put a buy order or a sell order on the order book, you're negotiating with someone opposite you. So if I'm trying to buy, I need to negotiate with someone to try to market sell to me. This is happening on the order book with lots of transactions going on per second. But really, it's the same kind of theory that we would have negotiating at a street vendor or negotiating in a business deal. When price is moving on low volatility, negotiating a good price is going to be easier, meaning that when price just really isn't moving much, trying to buy or trying to sell is probably not going to be as hard. Liquidity-wise, maybe because there's not as much trading going on. But with most retail traders with their position size, getting a good price in low volatility probably is going to be not that hard. However, when we try to negotiate with directional high volatility, this is where we begin to see some problems. What I mean by that is, imagine that price is flat and then just balloons upward. If you try to limit buy when price just goes really, really high upward, you're competing with a lot of other buyers who are also trying to get their orders filled as well. And a lot of those buyers are going to be using HFTs or bots that are going to make sure that their orders get filled at only the best price. Whereas when you put a limit buy order, or even when you market buy, if your order is filled, price is likely to move against you, especially when price is moving in high bullish momentum upward. If you place a buy limit order and continue to place it higher and higher, the moment that actually gets filled and you find a seller, may actually just be the top and you just bought at the worst price. Another reason that what can happen is, more often, you continue to put a bid up higher and higher, but your order never fills and price just moves beyond your limit price. So these two situations aren't great, and that's why we typically don't want to try to buy during a period of high volatility upward. We don't want to try to negotiate where we're just putting a limit buy order higher and higher and higher and higher in a very fast moving uptrend. We have two options in this situation with that example. we can just wait for low volatility. We can just wait for price to just slowly go sideways or slowly go down and then buy. Or we could even try to sell. Because if there are a lot of interested buyers, a lot of people who are trying to buy, and really not as many sellers, well, the sellers are going to be able to fetch better prices than the buyers are going to, because the buyers are getting desperate. They really want to buy in. A lot of market orders are probably going to come in. So if you want to, this is high risk, but you could try to trade against high volatility and try to catch a really good sell price due to the greed of many retail traders market buying up to, a very high price. And that's what I talk about here when we get that high volatility upward with where it's really hard to buy at fair price. And high volatility downward, it's going to be really hard to sell at fair price, because when price dips down and you put that limit sell order trying to get it filled, it's going to be harder for you to get filled. And if it does get filled, price might just move right against you. Quick little cheat sheet if that just was kind of a little too much. Low volatility range, which is going to be indicated in blue with the indicator here, blue, and orange. And high directional volatility, or actually just high volatility in general, is going to be orange. But the note that I'm putting here is if you get high directional volatility, so high momentum upward or high momentum downward, you don't really want to trade immediately with the trend at that current time. That you can, but it's typically not the best way to do that. Breakout trading, yeah, but we want to wait for low volatility and then have it continue upward. So you could trade against the trend for high risk play, because if you actually look here, some of the best places to enter are high volatility. Here, and I mean high places to exit or enter are those high volatility spots when we go against the trend. But it typically is just going to be better. Wait for the high volatility to just kind of vanish. Wait for low volatility, and then you can make your move. All right, so this is the indicator that I'm using with the settings on the 5-minute time frame. These settings may be a bit different on a different time frame, such as the 1 hour. You may need to adjust it, but this is good for the 5-minute. Let's take a look at our first example comparing volatility to price. And the darker orange with this indicator, the darker the orange, the higher volatility is at that point in time. The darker the blue, the lower volatility is at that point in time. Whenever you see a square pop up like this, that's showing that we're getting a quick period of high volatility. Whenever you see blue pop up at the top, that means you're getting a quick period of low volatility. So what I indicated here are just some spots where we may want to trade or even not trade. Here's a spot where we have high volatility, which is obscured by the webcam. But this is a period of orange. It's going to be tough to buy at the good prices. I mean, once you recognize that this uptrend actually is legit, once you know that it's actually going upward at this point, we get that high momentum, you're probably not going to get your limit buy order filled at any of these prices because price is going against you. I mean, beyond your limit buy price. And if you try to market buy, your order will probably fill at the top. So trying to buy high directional volatility, you're just negotiating a bad price. Just like in a business deal, or at a street vendor. What you're doing is just chasing price, negotiating at worse and worse prices until you get filled at the worst price possible. So what we may want to do is, I'm not advocating selling here. That's not what I'm saying. I'm just saying we don't want to buy. Not high volatility upward, and then a little bit more of stopping, as you can see here with a stop loss on potentially, and a lot of market buying occurring with that wick. Not a good spot to buy. Maybe you want to sell, but better to wait for this period here, the period of low volatility, which began right there, as you can see, of blue. This is a period of low volatility that is sideways, which is typically when I like to trade. I don't love trading low volatility downward or low volatility upward. I want to see a balance of the buyers and sellers, and that's going to be found when price is moving flat. So price is flat here, and this is a time where you may want to enter or exit a trade. You could try to sell. You could try to limit sell, and you could get plenty of good prices here. You do not have to panic sell at the bottom of this range. You can place a limit sell order around here and be confident that the low volatility is probably going to continue and probably will just fill your order. So you've sold, and then price balloons downward, and this is where you might be able to get out of the market. You definitely do not want to sell here. This is not a spot that looks good to sell at all. You just be selling at a very bad price to a very lucky buyer. But what you can do is wait for this period here to exit your sell. Now the reason I say that is we see low volatility here, and we see some low volatility around here, this is a time where we may want to exit or enter a long. If we believe that the market is bullish, this would be the best time to use an entry or an exit order and have the confidence that it will likely get filled. We buy here, let's say, and we reverse our position from selling, and price goes up. Great. Okay. High volatility up here, and let's say that we sell the high volatility. Not recommended, but you get out here. We then see some low volatility here that's moving about flat. We have resistance here, we have resistance here, some support here. Just it's really not leaving this range. And this would be a spot with this dark blue that we may want to position ourselves in a trade. This is a spot where you could try to sell and scalp down here. But 2020 hindsight, this is the spot where we probably want to buy. This is the base of the uptrend. This is really this. And the markup really is this, as you can see here. And this is the spot we do not want to market buy. And this is the spot we do not want to limit buy. If we really do want to buy, we need to be patient and we need to wait for the indicator to turn blue and then get low volatility. Again, I've said this many times, but when you get high directional volatility upward, we typically don't want to buy because we're negotiating for a very bad price. But if you want to sell here, I guess you could. If you want to short here for a little quick profit and then exit low volatility, that is a play that you can make. All right, so now let's take a look at another range, looking at the VCI. What we see here is a long period of flat, low volatility. Great spot to enter into a trade or exit a short if we were in a short before. So we can try to buy here during any of these blue periods where we're getting that low volatility. And it's going to be easy for us to catch a really good price. And then we position ourselves here and price goes upward. We could try to take advantage of this heavy buying and then the stopping of this heavy buying and try to sell, try to limit sell, because there are probably a lot of interested buyers who, once they see this, are looking to buy. We could sell at a very good price, take advantage of the fact that they really want to buy. Or what we could do is we see a little bit of the market calming down here. I'm seeing low volatility and a few markers of that there. We probably want to make our move here. Again, I would say 90% of the time I'm making my moves in low volatility. Only I'd say around 10% of the time I'm actually going to be trading high volatility. Now I only trade low volatility. It's just, I found that it's simpler to trade and that stop loss hunts can become not as bad when you're low volatility here. Not only stop loss hunts, but just getting your order filled at a good price. Because when you try to buy here, this is just kind of going to lead to disaster, where you're going to buy here and then you're just never going to close your position because price goes against you. But if you guys want to take 3 seconds for a non-volatility related question, this price either does balloon downward or just skyrocket upward. Which one do you think it does? All right. Yeah, it goes downward. We get low volatility, which leads to the market coiling up smaller and smaller and smaller until price goes down like that. And this would have been a great spot to sell, right? In this low volatility price range would have been a pretty good spot to sell. And if we had bought, if we really wanted to buy, it would be a lot better to buy around here and then put a tight stop loss here than it would be to buy here with no stop loss and then have this happen to you. Two different traders. One's using risk management and proper volatility technique. The other is just buying the high volatility and just keeping his position open. So you can imagine which one's probably going to have an edge in the market. And then we see a period of high volatility here. I'm not really interested in trading this in any shape or form. I want to wait for that low volatility to begin to come out. Here's another example that I would like to show on an altcoin this time and not on Bitcoin or Ethereum. So the blue again represents periods of low volatility, and we would probably want to buy in each one of these spots of low volatility. In here, we could probably get a good price. In here, we could probably get a good price too. And if we see this momentum and we still want to buy, this is a fine price to buy. We're being indicated that it is low volatility. Now, what we don't want to do is buy here. We do not want to buy up here or trade with the trend on high volatility, negotiating for a very bad price for a very lucky seller. Maybe we can try to sell against the trend in here or in here, but high risk again, maybe better just to wait for low volatility. which comes here. And then this would be a spot where you may want to look to enter or exit again to position yourself for the next pop upward or the next pop downward. So this is just going to be the last example that I did want to show that compares volatility to volume. Let's take a look at where the masses buy by looking at volume and the amount of price fluctuation, which is basically just the VCI, taking a look at volatility and volume. I'm seeing a large amount of volume being transacted here. I'm seeing a large amount of volatility, a volatility spike around that same price zone. I'm seeing a large amount of volatility here, higher than average, and I'm seeing a large amount of volume being transacted at these prices, at this price here. This is where the masses are going to be buying in. This is where many traders who want to market buy because they think that Bitcoin Cash is just going to keep going higher, this is where they buy. Where do we want to buy? Well, using volatility and using the technique that I showed today, what we're looking for is that beautiful low volatility dark price range here, where we can see very low volume, really not a lot of transactions occurring. How do we take advantage of this? We can try to buy the low volatility here with a limit order, or if we really want to and we still think that this is low volatility, we can even try to trail the order book. So just place a limit buy order up until it gets filled. You just continue to place your buy order up at the top of the order book and it will eventually get filled. This is something that I warned against with high volatility. With a low volatility, you can do that. It's an option you have. It's just something you do not want to do with high volatility to continue to trail the order book upward, because that's going to lead you transacting at a bad price. But if you try to do that here, we have a volume spiking around here and we're still low volatility. So buying here would be fine. Seems okay to me. And then we begin to see a period of high volatility, so we probably don't want to exit. We would only want to exit if we get extreme high volatility, and like here. And then we maybe want to trade against the trend, but maybe we just want to exit, when this price goes back up, as you can see here, and we get more low volatility. But you could also trade against the volume spike and the high volatility there. So that's going to do it for today's video. Just to recap on the topics that we covered, we took a look at the cycle of volatilities. That's looking at low volatility to high volatility to low and then just back again over and over. We also looked at negotiation for a good price. So when price is moving upward very quickly, it's going to be hard to buy at a good price. And when price is moving down very quickly, it's going to be hard to sell at a very good price. And we also looked at the Volatility Channel Index created by M59. And we looked at how we can use that indicator to try to screen for low volatility, to try to enter or to exit, or potentially trade against the trend in a high volatility situation where we see volume spiking and price goes high volatility upward and then a little bit flat sideways. That can be one spot where we trade against the trend. We also had a cheat sheet where we talked about the, again, negotiation tactics of the market, where we want to enter, exit in blue, and we want to wait until we get low volatility again, unless we want to make an advanced play here. All right, so that's going to do it for this video. And if you have any more questions or would like to learn more, you can check out my website below, or you can take a look at the Discord. Happy trading.